Let's say you're checking exchange rates. You might see one rate in the morning and a slightly different one by lunch.
In a single day, value shifts like a very gentle but unpredictable roller coaster.
Who changes these numbers? Is it a committee? A caffeinated economist? A hamster with little glasses running on an oversized calculator? I vote hamster. Of course, just kidding. No single person or institution sets exchange rates. Exchange rates are like a global voting system where countless trades cast ballots every second, and the winner is whatever price the global market agrees on right now.
I'm Jenny, and today we're uncovering why exchange rates change every single day, sometimes every single minute.
From Tokyo traders to Sao Paulo soybeans, we're exploring how everyday events around the world influence what your money is actually worth in another country. The basics. It's just supply and demand. At its core, exchange rates work like most markets. When demand for Japanese yen increases, it can boost its value, kind of like when everyone suddenly wants the same sneakers. On the other hand, when lots of people are selling a currency, it can push its value down. Supply and demand is one of the many things happening at once in the FX world.
Think of currencies like concert tickets. When a popular band announces a show, ticket prices typically spike because demand is high.
When the venue adds extra dates, prices often drop because supply increased. Currencies work similarly, except the concert is an entire country's economy and the tickets never stop trading. Every currency trade needs two sides. When you buy euros with dollars, you're simultaneously selling dollars for euros. Someone else is doing the opposite. The exchange rate is basically the price where these trades balance out. For freely floating currencies, no single committee sets this. It emerges from all the trading activity.
My economics professor used to say currencies are like a massive, never-ending auction where everyone's bidding on everyone else's money. He also made puppets out of his shedded cat hair, so we must take his metaphors with a grain of salt. But I think there's some truth there.
The traders. Who's actually trading? So who's doing all this trading? First, there are banks and financial institutions moving money for clients and themselves. Then, corporations buying and selling across borders, governments managing reserves, and increasingly, regular people sending money home, traveling, or shopping online. The foreign exchange markets sees trillions of dollars worth of currency traded daily, more than the annual economic output of many large countries, all traded in a single day. Most of these trades happen electronically, in fractions of a second, which is why rates can shift so quickly. One just happened now, and now, and now, and now. You get the point.
This market runs 24 hours a day during the work week. When London traders go to bed, Tokyo is waking up. When Tokyo closes, Sydney opens. When Sydney winds down, London's back. It's a weekday relay race that mostly pauses on weekends, though crypto markets continue around the clock.
What moves the rates? Here's where it gets interesting. Interesting being a relative word if you're into global finance, like me. Many different factors can influence exchange rates if they affect how people view a country's economy. Let me show you how various events create currency movements. Interest rates play a major role. When a country raises interest rates, its currency might strengthen because investors may earn higher returns there. It's like offering better rewards. Money tends to flow towards attractive returns, though that's just one ingredient in a complicated recipe. Trade patterns matter as well. If Japan exports lots of cars, buyers need yen to pay Japanese companies. This increased demand for yen can strengthen it. But if Japan imports more than it exports, this flips.
It's like the global economy is at a potluck. One country brings way more dishes than expected, another shows up with just vibes, and suddenly everyone's trading plates to keep it balanced.
High inflation can make a currency worth less over time, since each unit buys less. But again, it's one factor among many.
What's fascinating is how psychology and expectations work alongside economic fundamentals. Currencies can move on sentiment, confidence, or concerns about the future.
Unlike me, who very much does not move when I have concerns about my future, you can find me in bed with ice cream. Real events, real changes. Let's look at types of events that can affect rates. When major shipping routes face disruptions, currencies of trade-dependent nations might react. When elections approach, currencies often see more volatility as traders adjust positions. Natural disasters and new trade agreements clearly matter. Occasionally, even viral social media stories can play a small role if they shift market sentiment about major companies or economies. Presumably, they're about business deals, import-export news, and the like. Not, for example, the most unlikely animal friendship videos that I sent to my friends. In earlier decades, exchange rate updates visible to everyday people at banks or exchanges might change daily or less frequently. Now, algorithmic trading means wholesale markets respond to news quickly. Information spreads instantly, and markets adjust just as fast. By the time you read about an economic announcement, the currency market has already begun processing it.
Here's what makes it complex. Everything connects. A drought in Australia affects wheat prices, which influences trade balances, which affects the Australian dollar, which impacts every currency it trades against.
It's interconnected, with ripples spreading globally. Why your rate is different. The rate you see on financial news isn't usually the rate you get at the airport or from your bank or money transfer app. The news rate is typically the interbank rate, what large institutions pay when trading huge amounts.
Everyone else gets a different rate that includes costs and margins for the service.
It's like wholesale versus retail. The interbank rate is wholesale, bulk pricing for massive trades. Consumer rates are retail, smaller amounts with service costs included. The difference covers infrastructure, compliance, risk management, and the convenience of the service. Also, keep in mind that the exchange rate is only half the story. A provider might offer a rate that looks very close to the wholesale number, charge a higher upfront fee to make up for it. Another might have zero fees, but a different rate. To understand what you're actually paying, you have to look at the combination of both. And this is why you'll see different rates at different providers. Each has different costs, different update frequencies, different services. Providers balance factors like market volatility, fees, and speed differently. The wholesale market never stops moving. Consumer providers monitor that volatility and set a rate that balances current prices with the risk of future changes.
Quick note, companies like Remitly don't set the big interbank market rate. Nobody does. We all pull from the same global market and then offer our own customer price based on how our service works.
You might also see something called the mid-market rate online, which is basically the halfway point between buy and sell prices in the global market. And it's just a reference point, not a rate most people actually transact at. In big, high-volume currencies, that midpoint barely moves because the spread between the buy and sell price is tiny. But in smaller or less traded markets, the spread is much wider, so the midpoint itself can shift around more.
Kind of like how mango prices stay steady at a big supermarket, but bounce around at a tiny fruit stand where fewer people are buying and selling.
Attempting stability. Some governments actively manage their exchange rates. They might buy or sell their own currency, set official rates, or limit certain types of trading. Each approach involves trade-offs between stability and flexibility. Most major currencies float. Their value changes with market forces. Some countries peg their currency to another, like the US dollar, seeking stability for trade and planning. Others let rates float within a managed range. Each system has advantages and challenges depending on a country's situation.
When official exchange rates don't line up with what the market would expect, things can get complicated fast. It takes a lot of effort and resources to keep that system running.
And sometimes when there's a big gap between official and market prices, unofficial markets can pop up alongside them. The human impact. For most of history, exchange rates mostly mattered to merchants, traders, and travelers. Now that they affect anyone with family abroad, anyone who shops online internationally, anyone whose job involves imports or exports, a small rate change might seem minor, a fraction here or there, but those fractions matter. And fourth grade me never thought I would utter the last two words of that sentence. So, for example, when you're a business importing materials, these fluctuations affect everything from pricing to planning. This is why trying to time exchange rates doesn't really work. They move for all kinds of reasons, and not even experts can predict the short-term wiggles.
What's remarkable about exchange rates is that they're responding to real information and expectations, even if the day-to-day movements feel hard to predict from where we sit.
Conclusion. So why do exchange rates change every day? Because every day, millions of people and institutions trade currencies based on news, needs, analysis, and expectations.
It's a bit like trying to predict when a round of musical chairs will stop. I just watched this happen at my nephew's birthday party, and trust me, no one gets right.
For most freely floating currencies, there's no secret committee setting rates, no single algorithm deciding values. It's the aggregation of global economic activity translated into prices. Exchange rates move because the world moves. New information, new decisions, new expectations, all flowing in at once.
And while all of this can feel complicated, understanding the why behind these changing numbers can make the whole process feel a little clearer and a lot less mysterious.
While they were happening, countless trades occurred. News broke around the world, and markets processed new information. Complex? Absolutely. But understanding what's behind the movement makes the whole thing a lot less mysterious. Thanks for watching. If you found this video helpful, hit like and subscribe for more content that tackles topics that I think are worth discussing. Drop a comment with what you'd like to see next. I'm always up for covering something new.